Hello, everyone, and welcome back to this week's episode of Real Take Real Estate with the Joseph team. I'm your host, Maddie Maloney, and I'm joined here by my partners,
Joe Sambear
and Sam Fada.
So today we are going to be diving into a topic that can have a big impact on your financial well-being, whether you are a first-time homebuyer or you've been in your house for a while. There is so much to learn about the topic of refinancing, and that is going to be huge as we're coming up into a time where right now with the higher rate environment, what people are asking about is, okay, am I going to be able to refinance? What is that going to look like? And when is it going to be beneficial for me? So starting off, we are just going to be talking about, what is a refinance and what all does that entail? So Joe, I'm going to start off with you. If you could explain a little bit about what does refinancing really mean?
Yeah, that's a great topic for today. When we look at a refinance, there's really two types of refinances. There's a rate and term refinance, where you're just taking the existing balance, using that as the new loan amount. You may be including some escrows, or closing costs potentially, depending on how we structure the loan. That's considered a rate and term refinance, where there's no cash outside of the principal loan amount, the closing costs, and setting up an escrow. Then there's something called a cash out refinance. This would be used for paying off the principal balance and taking a lump sum out maybe to pay off some debt, home improvement, something like that. So those are really the two structures of a refinance. But one critical point is it is a completely new loan. So you have an existing loan you've been paying on. No matter who your servicer is, this will be a new loan with a new loan number, whole new underwriting processing of that loan. So that's an important thing to start with, just to understand what that means. The term can be changed. You can go from a 30-year mortgage to a 15-year mortgage or 20-year mortgage. So the amortization can be reset where it's a whole new 30-year mortgage or 20, 15, 10, etc. So that's the general description of what a refinance is.
Okay, perfect. So then when talking about a refinance and, for first-time homebuyers who maybe only just got their original mortgage and now they're learning about a refinance, what are some common misconceptions that people can have when thinking about a refinance and maybe if it's beneficial for them? What are some things that people typically run into?
So I would say one of the first ones we get is it's always a money saver. Refinancing is always going to save me a lot of money. The perception also that if I get a lower interest rate, it's worth refinancing. Just the pure look at my rate is here, it's being reduced there, it makes sense. The other one we get sometimes is it has to be a certain amount, like a full 1%. Like there's a rule that it should be 0.5% or 1%. Well, that's really not a good way to analyze it because it really depends on your loan amount. It depends on the cost. We'll get into that a little bit later, but that's another one is it has to be a certain percentage decrease for it to make sense.
Yeah, that's not always the case. There could be multiple times out there, where 0.5% could make a huge difference in what you actually save. Or if you're consolidating debt and, moving to a higher interest rate, that could also make sense to refinance at that point too, with the cash out refinancing. When you're consolidating higher rates, and your mortgage rate now might have a lower rate, but when you look at the bigger picture of what you're paying on all the other debt you're consolidating, it could make sense to combine the two and take a little bit higher mortgage rate. And then another misconception too is, do I need to have perfect credit to refinance? Does it make sense to wait until, if my credit's not perfect right now to look at refinancing later? And that's not always the case because there's programs out there where you can, qualify without the best credit and you might have money saving opportunities at that time if you're paying higher interest on other debt that you're consolidating. And then another misconception is, do I have to stay with my current lender? You can definitely shop that around. It doesn't matter who currently holds your current mortgage. You can always check with multiple companies to see who has the best rate and terms for your situation. So you don't have to stay with your current lender.
Definitely. And when you look at shopping around and finding a good lender, especially when it comes to refinancing, you want to make sure that your lender is taking into account the bigger picture and that they're talking with you about your goals and objectives. So not just looking at, oh, yep, we can get you 0.5% lower, so let's go through and do this. No, we want to make sure to see, okay, so how long are you going to be staying in this home? Do you need some cash out? You know, what is the bigger picture? What are your future financial goals for this home so that we can really make sure that this refinance is going to be beneficial, not just now, but for your future homeownership needs, and looking at, you know, the full financial picture. So that's one really important thing. And one thing that we continue to stress in this podcast is just make sure that when you're working with your team, they have your best interest in mind and they're taking into account the full picture and really having this as a conversation, so that we can really help you set yourself up for that financial help and just helping you out in the future. So yes, definitely great. All right. So any other misconceptions that we have? I feel like we went through a good amount of them right there. Joe, any other comments on that?
No, really, I would just say, as we lead into the total cost analysis, that's going to be where everything's going to get really clarified. So what we typically will do is we will look at the current situation, like Sam and Maddie had just laid out, of what's the total picture. What are we trying to accomplish?
What's your goal?
Yeah, life has different times in life where you need to do different things. And we find our customers in certain situations, maybe a spouse is returning to work and they can pay more aggressively for a shorter period of time. Maybe they're in a position in life where their children are in college and they really want to they have that additional expense and they really want to bring their payment down. So it's not purely a financial benefit always as far as the rate and the cost savings overall. But how we want to get started with is we needed to make those determinations. So what we typically will do is start with a total cost analysis, where we look, where are you exactly in your current loan? How much time is remaining? How much principal is left? How much interest do you have to pay still? And it's not, we see commonly that people skip over that step. They just look at, okay, what's my payment going to be?
People get hung up on the rate too.
Yeah, the rate, the payment, but let's just look at the whole cost, how long you plan on being there, and then we'll put that together to start the process and say, yes, this looks like it's going to take you 1.5 years to recoup these costs. You're going to be here for 5 years. This clearly is beneficial for you. And then we'll start taking in those other considerations like, well, I don't want a shorter term because I'm about to go into retirement and I want to keep my payment lower. Those, when we start adding those other features, but we want to start with first looking at that total cost. Let's put everything on the table and make sure we didn't miss anything. We don't want to just skip over a step and say, oh, you're going to save this much money a month. You should clearly do this.
Yeah.
We really like to get to the root of the cost and the benefit. Credit score will come into this analysis and how it may affect your rate. If you have existing mortgage insurance, we'll look at that. Is it something where, especially with how home prices over the last several years have increased fairly dramatically throughout the country, maybe your mortgage insurance could be removed or reduced. So there's a lot of reasons to start looking at and start planning. And this is something you can do today. You can contact us, even if rates aren't lower this minute. We can start having a conversation, a meeting about what would it take, when would it make sense. We also do this for our existing customer base. We look all the time. We'll go through our files and look and see, okay, who may be eligible for this. When we do get into a very low interest rate market, we're going to reach out to our customer and let them know you may benefit. But again, we need to get a little bit more information.
Perfect. So far we've gone over what is a refinance and everything that entails, making sure you know your goals and objectives. We've gone over the closing costs, the cost benefit analysis. And then the next part that we want to go over is a question that people most often have is this process going to look exactly like when I got a mortgage? Is this just a quick little process, or what does that really look like? So Sam, can you walk us through what the refinance process looks like?
Yeah, absolutely. So it starts off, obviously contacting your your lending team, your loan officer, making sure, you lay out your goals with them to figure out what your plan is for the future with the refinance, see what makes sense, and start building the plan from there. So sometimes what we'll do, there's no application fee to get the loan started. So we'll say, start building the plan and say, if this is something you want to do within the next few months, let's get a file set up, get it started. And if it doesn't make sense right now, we can keep that file active and, revisit it within a month or two. Just have it set up and ready to go. If we anticipate the market turning, it might not make sense now, but if rates turn a little bit more, it could make sense within a month or two. So really just having that file started and set up so we can review it, keep it top of mind, and make sure we have that best plan built out for your goals as we discussed. Then we'll, analyze that situation and get it going when it makes the most sense for you to move forward. The process looks pretty similar to when you purchase the home. It's a little more, not as extensive because there's less parties involved, obviously, without a seller. It's just your home and your existing loan that we're redoing. So starts off with getting pay stubs, bank statements, things like that we've gone over in past episodes, sending it through underwriting and processing. Some situations will need an appraisal. There are options through our automated underwriting system where if we submit the value, what we think it is, the system will take it, say appraisal is not required for this transaction. So an appraisal might be required depending on what the system gives us. And that could be a cost saver as well for the refinance. So if you don't have to pay that appraisal fee, less costs go into the transaction. And then, a lot of people get hung up. Oh, I don't want to have my house appraised. I don't have it cleaned, or it's not in the best shape right now. That's nothing really to worry about. It doesn't have to be perfect. The appraiser will require a full interior, exterior if the appraisal is required, but not a huge deal to have to worry about that. And then again, it's really not always about the rate too. So that, situation could be different for each individual person. So it's really just making sure you're in touch with the right lending team, and they'll make the process easy on you.
There's a few things, Sam, that I think are really important during a refinance process. Is you had mentioned starting the file early. And
Absolutely.
I think one of the reasons you brought that up is we find that just like anything in life, when rates come down, it seems like they go up faster.
Oh yeah, for sure.
So sometimes when we have an
Mm-hmm.
opportunity to do a refinance or a series of refinances,
Small window.
it's not uncommon that we did, we look at 20 customers all at once. It's going on. It's very rapid. It doesn't stay most of the time, in my experience of doing this for a long time. It's a very short windows. And so the customers that have their information, that have had these meetings, they'll benefit.
Oh yeah.
It's harder if you jumping at the last minute. We'd be more than happy to accommodate.
Yeah,
but
absolutely.
Sometimes the opportunity might not present itself for a while. You might have to wait a longer period of time.
Yeah, which kind of similar to the pre-approval process in a sense too. Really, you want to be set up and ready to go for when that right house comes up. Just as with a refi, you want to have that file set up and ready to go if the right opportunity presents itself.
Yeah. Yep.
So really what we're saying here is that if you think that a refinance would be beneficial in the future, or you really just want to have that conversation to say like, okay, I think that my financial situation may be changing. I think maybe it's going to be beneficial. It is so important to start having that conversation now with your lender. Even though rates may still be high, it's not going to be great right now, but getting that conversation started so that we're aware and we have everything ready so that when rates do fall, we are ready to go. We can just lock in that rate. We can get this process starting, and we don't have to slow down the process because, now rates are down. Now I want to have this conversation. Am I qualified for this? What are my goals? Going over everything there. Really just having that conversation beforehand so that you are prepared, everything that's going to be needed. And it just makes it so much easier for, the buyer or the borrower and the team just to be able to have everything all ready to go. So
there's two other things, Maddie. The time of the lock. Sometimes we're in a refinance situation. It's obviously different than the purchase, because a purchase we know, okay, you have to close this date. With a refinance, what happens is usually everyone's refinancing at the same time. which means the title companies get very busy. The appraisers get very busy. Everyone gets busy, and the time frames can adjust. So what we typically will do is do a lock that's a little bit longer. Doesn't mean we have to wait a long time to close, but we typically will do that just so if the situation presents itself where appraisal turnaround time is slower, the title companies are booked, that we have you covered for that long length of time. So if there is a reason during your refinance that you need to close earlier or a certain time, you just need to let us know, because otherwise we'll just kind of go through the normal process. But if that does come about, please let us know that you need to close within a certain window, or this is your goal. We'll talk about it as well. And the other thing is the loan amount. Everything's going to kind of adjust. So when we start that file, like Sam indicated, we're just going to take the current balance, not knowing when your next payment's due. So usually when we send out those initial disclosures, it might be off from where our final numbers are going to be. So what I always tell our customers is, we'll look at those initial disclosures, make sure that makes sense, but we're going to revisit everything about a week before closing. We're going to revisit it because everyone has a certain way they like the final loan amount. Some people like to bring their payment into closing. Some people want to pay the loan down. Some people don't want to bring zero to closing. So all those are options for most people. So we usually like to revisit everything about a week before closing. We'll get with you directly and say, okay, this is how we know we know all the factors. What would you like to have happen? And then we'll wrap it up. So if you get those initial disclosures or worried about that, we are going to revisit that one more time before closing. So just a side note.
Perfect. And so one of the last things that I want to go over is that, of course, I see on my social media feed a bunch of loan officers, when they're talking about refinancing, they're saying, oh, yes, so when you come back to refinance, it's going to be no cost. We're going to pay your closing costs. What does that really mean, and how are they able to do that? What should these borrowers be aware of when people are giving that option of having no cost for a refinance?
That's a really good question, because we're hearing this a lot right now. In particular, a lot of when you do the purchase, they say, if you come back within so much time, or there's not going to be any cost involved. And this has been common for a long time, where they just say there's no cost involved. Well, of course, there really is cost involved, because you have an independent appraiser who needs to be compensated. You have a title company who's usually independent that needs to be compensated. There's actual costs involved in doing this. So what they're referring to usually is you're going to get a higher interest rate, and we're going to pay your costs outside of that closing on your behalf. So just like you can buy your rate down and pay a discount fee to be under market or have a lower interest rate, the opposite is true too. If you go above the current rate environment, there's a credit that's available to pay those costs. That's considered a lender credit, lender paid closing costs. So that is most likely what they're referring to. So yeah, we do hear some of those comments, especially now.
Yeah, there's really two different ways to go about it. Take a little bit higher interest rate with no costs, or take the lowest possible interest rate and pay the full closing costs. So that's something we'll go through when refinancing. Again, that will be part of the initial conversation. What are your goals? Is it to have the lowest possible interest rate or the lowest possible costs for the refinance? And then kind of give them a couple different options at that point.
And a couple good reasons to do that to go with a little bit higher interest rate is if you were to tell us you're going to be in the house a very short period. So we don't have enough time to recapture the savings. Can't pay for the closing costs over a long period of time. And we're in a falling interest rate environment. We're in a rate environment where we're still not sure where the low is. Sometimes people go down the ladder and move down a few times if they have a larger loan amount, and try to do it at a lower cost. So
exactly.
They're not spending a lot of money.
So that brings up a good question. Is there a certain number of times that you can only refinance?
You can refinance as many times as you like.
Whenever it makes sense and whatever your goals are.
Yeah, and we've definitely had folks that have refinanced 3 or 4 times. I don't know if I've seen much more than that, but it's definitely happened.
Absolutely.
All right, perfect. Okay, so we've gone over what a refinance is, everything that it entails, making sure that your loan officer goes over your goals and objectives and that they have the bigger picture to be able to help you with your future financial goals. And we've gone over the closing costs, cost benefit analysis, how the process works as well, and what other lenders are offering when it comes to refinance. Any final thoughts on some advice that you would give to people as we start getting into, hopefully soon, a lower rate environment?
The only advice I would say is, again, no matter who you're working with, get some documentation in front of you that shows the total cost analysis. Mm-hmm. Make sure you have a loan estimate. Make sure you've asked the questions of the cost. If they say there is no cost, dive deeper and understand, am I paying at an interest rate? Just ask a couple good questions. Don't be afraid to reach out to trusted advisors, realtors, financial planners if you feel like you need a little bit more help and direction. I don't think that's ever harmful to do that.
Yeah, that's good. And the one thing I would say is don't get hung up on that interest rate again, because there can be, if you're not working with the people that don't have your best interests in mind, they could offer the lowest interest rate, and there could be additional fees in there that you may not be aware of. So just make sure you're diving deeper with those fees. Don't get hung up on the interest rate, and do what's best for you at the end of the day.
Definitely. And so if you are in the market for a trusted advisor, of course, we are here for you. We are more than happy to help look over your loan estimate, have that conversation with you on whether it is going to be beneficial to refinance and what that may look like in the future. So thank you again, everyone, for tuning in to our episode today with Real Take Real Estate and getting to know everything that you need to know for refinancing your mortgage. If you loved today's episode, please don't hesitate to leave us a review, contact us if you have any questions, and we hope to see you on the next episode. Thank you so much.